We're going to start with the question gripping markets and households at the same time. Is there really a US-China deal? And if so, does it actually change anything about prices, supply chains and political risk? The optics have certainly been dramatic. Warm photographs, a show of personal rapport and talk of breakthroughs. But even after the handshakes, the substance remains hazy. The choreography matters, the theatre matters, but underneath it, the policy mechanics look more like incremental staging than a final settlement. At the centre sits a cluster of issues that play well with domestic audiences in Washington: fentanyl, precursor chemicals, cross-border enforcement, and a broader narrative of toughness. It's not just China either. Previous rhetoric has wrapped in North American partners when it comes to precursor flows. Against that backdrop, the administration has sold tariffs as both leverage and protection. The politics are clear, the economics are messier. The immediate blowback of earlier tariff rounds wasn't confined to consumer prices. It knocked into farm country too. China pared back US soybean purchases during past flare-ups, hitting growers in the Midwest and Plains. Over the longer arc, Beijing's soybean sourcing strategy has tilted further towards South America, a shift reinforced by risk diversification priorities under Xi's food security push. Monthly swings can be sharp. In some months, China has imported no US soybeans, instead drawing heavily from Brazil and Argentina. But the broader picture is that trade flows are now structurally less predictable. There's also the strategic materials layer. Rare earths once lived at the edge of public awareness. Now they sit centre stage in nearly every debate about clean energy, advanced manufacturing and defence platforms. China doesn't just mine a lot of rare earths, it processes the vast majority of them, exerting outsized influence on prices and availability. Public data and recent regulatory moves all point in the same direction. Beijing controls most of the processing chain, and alternative capacity will take sustained investment and years to scale. Those are the fundamentals that undercut slogans about swift decoupling. That's the macro stage. But what does any of this look like at the checkout line? Retail analyst Phil Lempert, widely known as the supermarket guru, lays out a blunt baseline for US households. Phil Lempert, retail analyst, said, since the pandemic, food prices here in the US are up over 24%. The precise month-to-month inflation pulse has cooled compared with the 2022 peak, but federal data show food prices in 2025 still running higher than overall inflation and, crucially, sitting far above pre-pandemic levels, a cumulative gap that shoppers feel every week. Layer on this year's additional mid-single-digit increases and the prospect of more pressure into 2026, and you get the consumer behaviour shifts he describes: more store brands, more frozen, less waste, fewer restaurants. When asked what's driving the pressure, Lempert doesn't duck the trade angle. Phil Lempert, retail analyst, said tariffs have a major factor. And we have a lot of food that's rotting in the field. In his view, the culprits are overlapping: tariff costs on inputs, machinery and feed, immigration enforcement frictions depressing farm labour supply, and the uncertainty tax, sudden rule changes that derail planting, purchasing and logistics plans that farms and retailers normally set many months in advance. The result shows up not just in groceries, but in seasonal goods your kids see on shelves. When most Halloween costumes are sourced from China, a 20 to 40% jump in price isn't just an anecdote, it's a signal of tariff transmission into end-user categories. Household coping strategies are exactly what you'd expect when real purchasing power is squeezed. Store brands became a safety valve at first, then their quality rose, turning them into a destination in their own right. Freezers became a budget tool. And across the country, waste awareness finally went mainstream, a silver lining given the long-standing estimate that roughly 40% of food in the US gets wasted, much of it at home. In restaurants, the cycle is harsher. Rising input costs force price hikes and shrinkflation in portions just as stressed customers decide to stay in. The labour shortage compounds it, so do higher wages needed to hire and retain staff. Some chains hedge with futures or scale advantages. Independents often cannot. Technology, meanwhile, is having a reality check. Pandemic-era bets on fully automated walkout stores collided with how people actually want to buy food. As Lempert puts it, shoppers still want to talk to a butcher, see and smell fresh, and have a human-centric front of house. Phil Lempert, retail analyst, said supermarkets, as a result of the pandemic, again threw stupid money at stupid ideas. The pivot is toward using automation and AI where they're least intrusive but most powerful. Backroom operations, better demand prediction tied to weather and local events, and customer-facing digital tools that solve a real task, meal planning for a picnic with dietary constraints instead of showcasing gadgets for their own sake. Even if a US-China negotiation trims tariff lines around the edges, Lempert's caution is that the bigger force now is unpredictability. He's seen the cycle, a harmony headline, then a new set of duties, a soybean order today, a pause tomorrow. In other words, any relief risks being overshadowed by volatility itself, the variable that capital, crops and carriers hate most. The politics continue in parallel. Photos of Xi Jinping greeting a US President, Donald Trump, as of late October 2025, audibly echo through the coverage. But it's worth separating the handshake from the primer on rare earths policy and export controls. Beijing's recent interim regulations aim to tighten licensing and compliance across the rare earths chain. Washington and allies are racing to fund mines, separation plants and magnet manufacturing closer to home. That's the strategic scaffolding around any deal news. On nuclear testing rhetoric, there's another reality check. Proposals to resume US testing make waves, but the historical record still shows the last American test happened in 1992, and mainstream scientific and policy assessments say the stockpile can be certified without explosive tests using today's stewardship programs and supercomputing. Whatever the signalling value in negotiations, the technical case for testing remains weak, and any move in that direction would jolt non-proliferation debates worldwide. Let's shift south, where Argentina offers a real-time case study in shock therapy politics. 2 years into Javier Milei's presidency, the country is still testing the proposition that swift, painful fiscal surgery, subsidy cuts, ministry consolidation, public headcount reductions can stabilize an economy that had become synonymous with runaway inflation and serial crises. The political bet, as supporters tell it, is short-term pain for long-term gain. The risk is social fatigue setting in before the stability dividend is broadly felt. Our correspondent on the ground sketched the social texture. Jules, Buenos Aires correspondent, said the country was in an absolute crisis mode when Milei vaulted from outsider to president amid triple-digit inflation. Voters were exhausted. Many concluded that further delay would only make eventual cuts harsher. In Milei's first phase, the austerity was real. Rapid slashing of primary spending and subsidies, symbolic chainsaw branding, and a devaluation designed to narrow some of the distortions that had spawned multiple exchange rates. Markets rewarded the initial steps. Bonds and equities bounced as a sign that at least a pathway to stabilization existed. But even with lower headline inflation than the pre-inauguration peaks, the lived experience is punishing. Jules, Buenos Aires correspondent, said people are really struggling and not having enough money to actually live. Middle and working class households feel it in rent volatility after rule changes, in supermarket bills that now reflect fewer price controls and trimmed subsidies, and in the nagging uncertainty about the peso's true value. Many keep dollars as a lifeline and spend pesos quickly. Small and mid-sized businesses, stripped of subsidized cushions, are closing in greater numbers than before. The cultural impulse to gather and go out still resists the economic gravity, but it can't beat it every weekend. The policy constraints are also familiar to anyone who followed earlier reform waves in emerging markets. Milei doesn't command a blank check in the legislature. Privatization plans and tax code rewrites need votes he doesn't fully control. This is why political signals, midterm results, coalition gestures, external financing carry outsized weight. When Washington offered an economic stabilization support package earlier in the year, local analysts described it as a financial and psychological lifeline. Dollar reserves help enforce a more stable path for the peso. Credibility with creditors nudges risk premia lower. But lifelines are not destinies. The sustainability test arrives when large-ticket external debt falls due in 2026 and when patience on the street meets the timeline of reform dividends. Markets, for now, are voting with cautious optimism. That aligns with the textbook sequence. Fiscal consolidation first, some deregulation, some foreign capital. Then, if the social contract holds, growth and disinflation take firmer root. Israel's 1985 stabilization program is often cited as the success template, a cross-party, cross-society compact that crushed hyperinflation, then re-anchored expectations and investment. but the analogy has limits. Argentina is trying to build consensus after taking the leap, not before. Its institutions are resilient but politically polarized, and its exposure to external shocks, commodity swings, global rates, complicates scoping the pain window. The single biggest risk is political legitimacy eroding before the promised recovery spreads beyond market tickers. Back in the United States, all of these threads, trade volatility, supply chain rewiring, food inflation's hangover, and restaurant retrenchment, feed a broader unease about living standards. Households start by cutting discretionary spend. They then aim at the fixed costs that aren't so fixed, swapping brands, stretching meals, hunting discounts, and skipping nights out. The spillovers are everywhere. Bars and clubs feel it. So do clothing and durable goods. Social media amplifies the mood. TikTok and Reddit make inflation less an abstract number than a daily shareable frustration. Underneath, the math is merciless. Food is taking a bigger slice than it did 5 years ago. Housing is still dear, and medical and insurance costs aren't cooperating either. So the paradox of 2025 sticks around. A labour market that has cooled but not cracked, and a consumer that looks okay in aggregate data while feeling anything but in the aisles and at the pump. If spending finally stalls, the pressure shifts to the Federal Reserve. Policymakers would face a hard trade-off if inflation proved sticky just as demand rolled over, cut sooner to cushion growth or hold longer to finish the price stability job. That's the danger zone nobody wants, because getting it wrong on either side risks prolonging the discomfort. What should shoppers expect next? Lempert is direct. Phil Lempert, retail analyst, said, "I don't think the price of food is ever going to come down." That doesn't mean prices accelerate forever. It means the base is permanently higher unless something dramatic changes in productivity, climate resilience, or logistics efficiency. Agriculture is weather, water, and soil before it's anything else. Cocoa shocks in West Africa ripple into Halloween candy sizes. Drought and floods move coffee prices in Brazil. Some California crops have already migrated south in search of workable conditions. Indoors, controlled environment farming can help at the margin, but won't replace broadacre agriculture for staples soon. Add in trucking capacity constraints and wage competition, and you're left with a supply chain that's simply more expensive to run than it was. Trade policy can help at the edges, dropping a tariff here, opening a quota there, but it can't by itself bulldoze through climate and labour realities. Nor will tech shortcuts at the storefront fix a cost base built in fields, barns, warehouses, and highways. The most useful technology will continue to be the least flashy: better forecasting, smarter replenishment, and digital tools that make real tasks easier for real people. The best retail formats will keep leaning into what food actually is: sensory, social, and human. So is this US-China moment a turning point? It's certainly a pause in the escalation, with photo ops to prove it, but the deeper trend has already reset the playing field. Both sides are now building redundancies into supply chains. Both are using national security frames for trade, investment, and tech, and both are assuming that the other may not be a reliable counterparty in a crisis. That's a world where the deal of the week matters less than the infrastructure being poured into mining in Australia, separation plants in the US, and magnet factories closer to end markets. It's a world where soybean cargoes move like chess pieces, and where a single month's pause can flip sentiment for an entire harvest season. Meanwhile, in Buenos Aires, stabilization will be decided not by slogans, but by stamina. Can the president keep a legislative pathway open? Can households hang on long enough to see real incomes turn? Can external partners keep the financing bridge intact without moral hazard? If yes, Argentina's recovery could be more than a market sugar high. If not, the cycle risks repeating. To close, a few key lines kept verbatim and clearly attributed that capture the heart of what you heard. Phil Lempert, retail analyst, said, since the pandemic, food prices here in the US are up over 24%. Phil Lempert, retail analyst, said, tariffs have a major factor. Phil Lempert, retail analyst, said, we have a lot of food that's rotting in the field. Phil Lempert, retail analyst, said, supermarkets as a result of the pandemic again threw stupid money at stupid ideas. Phil Lempert, retail analyst, said, I don't think the price of food is ever going to come down. Jules, Buenos Aires correspondent, said the country was in an absolute crisis mode. Jules, Buenos Aires correspondent, said people are really struggling and not having enough money to actually live. Those quotes sit inside a larger picture that the data now support. Food inflation has cooled but not reversed. rare earth dependence remains a structural vulnerability, and trade flows have been rerouted in ways that won't fully snap back, even if tempers cool for a season. The deal, if it exists, is at best an intermission. The real test is whether policy, at home and abroad, can lower volatility enough for farmers, firms and families to plan again. Until then, the smartest strategies will be the pragmatic ones: diversify where you can, spend where it counts, and treat happy headlines as pleasant surprises rather than dependable guides.